Most people who watch a video like this already know they need to save more. They already know compound interest matters. They already know they started later than they wanted to. That is not the problem. The problem is that every generation, yours included, keeps falling into a financial trap that has nothing to do with laziness, nothing to do with ignorance, and nothing to do with how much money you earn. It has everything to do with a single behavioral pattern that repeats across decades, across income levels, across every demographic you can name. And the worst part is that it never feels like a trap while you are inside it. It feels like progress. It feels like you are doing exactly what you are supposed to be doing at your stage of life. Let me be direct about that. If you are over 40 and you feel behind financially, there is a very high chance you have been caught in this trap for years without recognizing it. Not because you are careless, because the trap was designed to be invisible. By the end of this video, you will know exactly which version of it you are living in, and you will know the 3 specific shifts that break the cycle permanently. Here is what nobody tells you about building wealth. The obstacle is not income. It is not even timing. The obstacle is that every generation gets handed an unwritten definition of what financial success is supposed to look like, and then spends decades funding that appearance instead of building actual financial substance underneath it. Not the signal of wealth, the substance of wealth. Those are 2 completely different things, and confusing them is the single most expensive mistake you can make with money. Think about that. Your parents had a version of this. You have a version of this. Your kids have a version of this. The costume changes every decade. The trap underneath it never does. A man works his entire career, buys a home, maintains it beautifully, watches it appreciate 4-fold, and arrives at 68 with most of his net worth locked inside walls he cannot easily sell without uprooting his entire life. A woman earns 6 figures for 20 years, upgrades her car with every promotion, moves to a bigger house when the salary allows it, takes the vacation she earned, and arrives at 52 with less saved for retirement than someone making half her income who started investing a decade earlier. Neither of these people did anything reckless. Every individual choice they made was reasonable. That is the trap. No single decision looks wrong. The pattern is devastating. Trap number 1, the lifestyle match. This is where it starts for almost everyone, and it is the most dangerous because it disguises itself as reward. Every time your income goes up, your spending goes up to match it. You get a raise, you upgrade the car, you hit a new salary bracket, you move to a nicer neighborhood. You earn a bonus, you book the trip. Each individual upgrade feels completely justified. You worked for it. You earned it. Nobody looking at any single purchase would call it irresponsible. But here is what is actually happening to your finances. The gap between what comes in and what goes out, which is the only gap that actually builds wealth, stays almost exactly the same size. It just operates at a higher number. You are earning more and spending more in nearly perfect proportion, which means your savings rate stays flat year after year after year. Data from Goldman Sachs showed that 41% of people earning over $300,000 a year report living paycheck to paycheck. 4 in 10 people making 300 grand cannot get ahead. That is not an income problem. That is a structural problem. The lifestyle matched the income so precisely that there was nothing left to compound. The research in The Millionaire Next Door found that the most effective wealth builders kept their spending habits roughly the same while their income grew. They let the gap widen. They did not let the lifestyle absorb the raise. That widening gap is where wealth actually lives. Trap number 2, the single asset illusion. This one is counterintuitive because the person caught in it genuinely believes they are wealthy. On paper, they might even be right. But the wealth is concentrated in one place they cannot easily access. The most common version of this is the house. Someone buys a home at 30 or 35, pays the mortgage faithfully for decades, watches the property appreciate significantly, and arrives at retirement age with a home worth 4 or 5 times what they paid for it. Looks great on a net worth statement, but here is the problem. You live in it. You cannot spend your kitchen. You cannot invest your backyard. The only way to access that wealth is to sell the property or take on debt against it, both of which come with significant costs and consequences. Research from Ritholtz Wealth Management found that households with a net worth between $1 and $2 million had roughly 66% of their total wealth tied up in their primary home and retirement accounts. 2/3 of their supposed wealth was functionally inaccessible for daily living or new opportunities. This is not just about houses. It applies to anyone who has too much concentrated in a single stock, a single business, a single piece of real estate. Financial advisors generally recommend that no single holding exceed 5 to 10% of your total portfolio. When you violate that principle, you are not diversified. You are betting, and betting feels like confidence right up until the moment it does not. Stop for a moment. If you added up everything you own right now, what percentage sits in one single asset? If the answer is more than half, you are inside this trap whether it feels like it or not. Drop one word in the comments, just one. Whatever your biggest financial blocker is right now. Fear, confusion, debt, procrastination, whatever it is. And by the way, the Trip to Wealth Google Sheet is linked below, and it will help you diagnose exactly where your system is breaking down. Now let us get to the part most people never reach. Trap number 3, the invisible tax drain. This is the trap nobody wants to talk about because taxes feel inevitable, like weather, something you endure rather than something you manage. But let me be direct about that. Taxes are likely your single largest annual expense, larger than your mortgage, larger than your car payments, larger than groceries, utilities, and insurance combined. And most people over 40 are paying significantly more than they need to because they have never been taught to think about tax strategy as a wealth-building tool. Here is a concrete example. A 47-year-old earning $95,000 a year who is not maxing out their 401k is paying taxes on income they could be sheltering. If they contributed the full amount allowed, they would reduce their taxable income by over $23,000. At a 22% tax bracket, that is roughly $5,000 a year they are handing to the IRS instead of directing toward their own retirement. Over 15 years, that $5,000 annually, invested at a 7% return, becomes over $125,000. That is not a rounding error. That is a life-changing amount of money. Common mistakes include holding dividend-paying investments in taxable accounts instead of tax-sheltered ones like a Roth IRA, failing to use tax loss harvesting to offset gains, and underestimating capital gains liability when selling positions. Every dollar you give away unnecessarily in taxes is a dollar that cannot compound for you. The IRS will always take their share. Your job is to make sure their share is accurate and not inflated by your own inattention. Now here is where I need to connect all three of these traps together because they do not operate in isolation. They compound against you in sequence. The lifestyle match ensures you never create a gap between income and expenses. The single asset illusion gives you the feeling of wealth without the flexibility of wealth. And the invisible tax drain silently reduces the effectiveness of whatever you do manage to save. These three traps working together can cost a household hundreds of thousands of dollars over a 20 to 30-year period. And the cruelest part is that the person caught in all three genuinely believes they are doing well. They have income. They have a home. They pay their taxes. By every visible standard, they look like responsible adults managing their money. That is the trap. The visible standards are wrong. They measure the costume, not the person wearing it. Think about that. Every generation absorbs a definition of financial success from the culture around them, and then spends decades funding that definition without questioning whether it actually leads to financial freedom. For boomers, the definition was the house. For Gen X, it was the lifestyle that matched the career. For millennials, it was experiences and travel. For Gen Z, it is the curated aesthetic performed online. Different costumes, same trap underneath. You spend money performing a rival instead of engineering it. And the performance always costs something, not discipline, not motivation. Architecture you were never taught. None of this is your fault, but it is your responsibility now. So here is the diagnostic. One rule. If your wealth system cannot run for 30 days without your active attention, you do not have a system. You have a collection of habits, and habits break under stress. A real wealth architecture means your investments are automated, your tax strategy is set for the year, your savings rate is locked in before you see your paycheck, and your asset allocation is diversified enough that no single event can derail your entire financial future. If you had to go completely offline for a month, would your money still be moving in the right direction? Would contributions still flow into your retirement accounts? Would your expenses stay within the boundaries you set? If the answer is no to any of those, you have identified exactly where the architecture is missing. 3 questions to diagnose your current position right now. Question 1. What percentage of every raise in the last 5 years went directly to increased spending? If the answer is most of it, you are inside trap 1. Question 2. What percentage of your total net worth is locked in a single asset you cannot access without selling it or borrowing against it? If it is over 50%, you are inside trap 2. Question 3. When was the last time you reviewed your tax strategy, not your tax return, but your actual strategy for minimizing what you owe? If you cannot remember, you are inside trap 3. Screenshot this. Write it down. This is not entertainment. This is a diagnostic. My friend, treat it like one. The signal changes every decade. The substance never does. Assets that compound. A gap between income and expenses that widens over time instead of staying flat. Tax efficiency that keeps more of what you earn working for you instead of disappearing into bureaucracy. Liquidity that gives you options instead of constraints. That is the entire playbook. It does not require a finance degree. It does not require perfect timing. It does not require starting at 25. It requires one decision. Stop funding the appearance of wealth and start engineering the architecture of it. If you are 43 and you have 80,000 saved and you feel behind, hear me clearly. You are not behind because you failed. You are behind because nobody gave you the blueprint. The blueprint is simple. Automate your savings before your lifestyle can absorb your income. Diversify your assets so no single holding controls your future. Optimize your tax strategy so the government takes what they are owed and not $1 more. And build a system that runs whether you are paying attention or not. One decision. Build the architecture or keep managing the chaos. Built with intention, wealth becomes irreversible. If this breakdown brought you clarity, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. Thanks for watching. I'll see you in the next one.